In 2025, Porsche's profits didn't just decline, they collapsed. Its profit fell by around 98%, from more than 5 billion euros to just 90 million euros. Even more shocking, Porsche sold fewer cars in China, once its biggest market, than it did in Germany. And the biggest problem is that Porsche can't simply walk away from what caused this crisis. The company spent years betting its future on electric vehicles. The Taycan was supposed to be more than just another Porsche. It was meant to represent the future of the entire brand. Porsche had promised that by 2030, around 80% of its sales would come from fully electric vehicles. But today, the company is struggling to sell some of those EVs. Ironically, the model helping Porsche survive isn't the electric future it spent years promoting. It's the type of car Porsche had been telling customers was slowly becoming part of the past. So, how did Porsche get here? To understand the fall, you first have to understand how successful Porsche once was. For decades, Porsche was one of the most profitable car brands in the world. In its strongest years, it achieved operating margins close to 18%, more than double what is considered healthy for much of the automotive industry. The company survived world wars, oil crises, recessions, and even a near bankruptcy crisis in the early 1990s. While brands such as Saab, Pontiac, and Hummer disappeared, Porsche continued to grow stronger. Then came another remarkable moment. In 2022, Porsche went public and was temporarily valued higher than Volkswagen, the parent company that still owned most of it. The child had briefly become more valuable than the parent. That showed just how powerful the Porsche brand had become. So when Porsche made its biggest bet ever, the automotive industry paid attention. The bet was electric. In 2019, Porsche launched the Taycan, its first fully electric production car. This wasn't a small experiment. Porsche wanted to prove that it could dominate luxury EVs, just as it had dominated performance cars. The formula looked convincing: Porsche engineering, sharp handling, premium interiors, high performance, and an iconic badge. Then, in 2021, Porsche announced an even more ambitious plan. By 2030, roughly 80% of all Porsches sold would be fully electric. Models like the Macan, Cayenne, and Panamera would move toward electric power, while the legendary 911 would remain the emotional link to Porsche's traditional gasoline-powered identity. Porsche invested billions into this vision, into factories, software, EV platforms, and batteries. It even partnered with the Swedish battery company Northvolt as part of its electric strategy. At first, everything seemed to be working. The Taycan won awards and gained strong attention. In 2023, Porsche sold around 40,000 Taycans, impressive numbers for a luxury sedan costing more than $90,000. Analysts began viewing Porsche as one of the few traditional automakers that could successfully compete with Tesla and other EV companies. But then the momentum started disappearing. The first major warning came from China. By 2021, China had become Porsche's largest market, accounting for more than 30% of its global sales, nearly 96,000 vehicles in 1 year. Chinese consumers had traditionally loved German luxury brands, and Porsche represented the highest level of status and performance. China wasn't simply an important market for Porsche. It had become a major part of the company's entire growth strategy. Then Chinese buyers began turning away. The surprising part was that they weren't abandoning cars. They were buying plenty of them. They just weren't choosing Porsche anymore. The reason was a major shift in consumer expectations. Chinese automakers such as BYD, NIO, and Xiaomi began producing electric vehicles with advanced technology, modern interiors, impressive software, and competitive performance, often at dramatically lower prices. Suddenly, Porsche had a problem. Its famous badge and engineering still carried enormous value, but technology was becoming just as important to luxury car buyers. And in China, Porsche was discovering that its traditional strengths were no longer enough. The company had spent billions preparing for the electric future, but the very market that was supposed to help lead that future was now showing Porsche that the EV revolution might not go according to plan. And that is where Porsche's biggest problem began. One of the clearest examples came from Xiaomi, a company most people knew as a smartphone maker. Then, Xiaomi entered the automotive market with its first car, the SU7, and quickly became a serious competitor in the EV space. For Porsche, the bigger problem was the generation buying these cars. The average Chinese EV buyer is relatively young, around 36 years old. Many of these customers don't care much about Porsche's racing history or decades of heritage. Their expectations are different. To them, a car is basically a smartphone on wheels. They care about software, large screens, connectivity, charging speed, technology, and autonomous driving features. That represents a huge change for the luxury car industry. For more than a century, brands like Porsche built their businesses around the idea that customers would pay a premium for the badge, the history, the craftsmanship, and the story behind the car. The story was part of the product, but a young buyer in Shanghai might look at a Porsche Taycan and a Xiaomi SU7 and see things differently. The badge matters, but the technology matters more. And Chinese manufacturers were offering impressive technology at a much lower price. Porsche had spent nearly a century building a brand around qualities that a new generation of buyers was beginning to value less. The sales numbers made the problem impossible to ignore. Porsche's China sales fell sharply in 2024 and declined again in 2025, ending the year more than 26% lower. Then, in the first half of 2026, sales dropped another 32% to roughly 14,000 vehicles. For the first time in recent memory, Porsche sold fewer cars in China than it did in Germany. The market that was supposed to be a major part of Porsche's future had become one of its biggest problems. And then the car at the center of Porsche's electric strategy started struggling too. The Taycan was supposed to be the flagship of Porsche's EV revolution. Instead, it developed a reputation for reliability problems. Owners reported warning lights, electronic failures, recalls, and other issues, while Consumer Reports ranked it among the least reliable vehicles in its category. But reliability wasn't even the biggest problem. The bigger issue was value. A base Taycan cost close to $90,000, yet its range was far below what many cheaper competitors offered. Tesla could deliver significantly more range, while Chinese EV makers were offering impressive technology and longer range for much less money. Porsche was being squeezed from both sides. And then it made an unusual move. It started offering heavy discounts. Dealers began cutting tens of thousands of dollars from Taycan prices just to move cars off their lots. That helped sales in the short term, but it created a much bigger problem for Porsche: its premium image. A Porsche is supposed to be a car people save for and wait for. It is supposed to feel exclusive and hold its value. When a $100,000 luxury car suddenly receives huge discounts, customers start questioning what the car was actually worth. Existing owners suffer because their resale values fall, while new buyers learn that waiting for a discount can save them thousands. The Taycan's resale value weakened significantly, damaging one of the most important advantages Porsche had always enjoyed. And customers noticed. The sales collapse was dramatic. Porsche sold around 40,000 Taycans in 2023. By 2025, that number had fallen to roughly 16,300. Then, during the first half of 2026, sales dropped another 25%, reaching only around 6,000 units globally. In some Chinese dealerships, sales reportedly fell to just 1 or 2 Taycans per month. The vehicle that was supposed to represent Porsche's electric future was now struggling to find buyers. Porsche has even been considering whether the Taycan name should eventually be merged into the Panamera lineup, potentially bringing the standalone model to an end. But the problems didn't stop with the Taycan. The foundation of Porsche's broader electric strategy was also beginning to crack. One of the companies Porsche had been relying on for its electric future was Northvolt, the Swedish battery manufacturer. Northvolt filed for bankruptcy in late 2024, creating another major problem for Porsche's EV plans. The company's battery strategy was suddenly less secure, and future electric projects were affected as well. The next-generation electric 718 sports car, for example, faced significant delays. After spending billions preparing for an electric future, Porsche was now facing a reality it hadn't expected. The technology was changing faster than the brand could adapt. Chinese competitors were becoming stronger. EV demand wasn't growing as quickly as expected, and Porsche's own electric flagship was struggling. The company had made one of the biggest bets in its history on the future of electric cars. Now, that future was starting to look much less certain. Then Porsche began reversing some of the decisions it had made during its electric push. The company shut down its own battery operation, laid off employees, and wrote off hundreds of millions of euros in investments that were no longer expected to pay off. The electric Macan also arrived about a year late because of software problems, while costing significantly more than the gasoline model it was replacing. Then came the numbers that showed just how serious the situation had become. In 2025, Porsche's operating profit collapsed by around 98%, falling from more than 5 billion euros to just 90 million euros. The company also recorded billions of euros in write-downs connected to its struggling. Electric vehicle strategy. Think about what that means. One of the most profitable automakers in the world had suddenly come close to making almost no operating profit. And the massive EV bet was at the center of the problem. Porsche tried several ways to stop the damage. It heavily discounted the Taycan. It relied more on hybrid vehicles. It introduced more affordable models in China to try to recover lost customers. And it kept gasoline-powered models alive much longer than originally planned. But none of these moves could reverse the situation quickly enough. So Porsche began retreating from the strategy it had spent years promoting. The biggest change was perhaps the most important one of all. Porsche quietly abandoned its target of having 80% of its sales come from electric vehicles by 2030. The central goal of its entire EV strategy was gone. Instead of announcing a new aggressive target, Porsche shifted toward a much more flexible approach, saying it would continue offering gasoline, hybrid, and electric vehicles for many years. Other changes followed. Porsche ended production of the combustion-powered 718, began scaling back parts of its gasoline strategy, and announced plans to cut around 3,900 jobs. In China, it also shut down around 200 DC fast charging stations that had been built at significant cost. At the same time, Porsche began reducing its Chinese dealership network from roughly 150 locations to around 80. This wasn't simply a company adjusting its strategy. It was a company getting smaller. And the problems reached the top of the organization as well. Porsche removed its chief financial officer and its sales chief and brought in new leadership to try to stabilize the business. The executives who had helped steer Porsche toward its aggressive electric strategy were now being replaced as the scale of the problem became impossible to ignore. In a leaked message to thousands of German employees, Porsche's CEO reportedly acknowledged just how serious the situation had become. Sales in China had reached historic lows. EV profit margins were significantly below those of gasoline-powered cars. And new trade pressures, including US tariffs on European imports, were adding even more pressure because Porsche imports its vehicles into the American market from Europe. The message was becoming clear. Porsche's old business model was no longer working the way it once had in a rapidly changing China and global trade environment. So, by 2026, the picture looked dramatically different. China was collapsing. The Taycan was struggling. Profits had almost disappeared. Thousands of jobs were being cut. And the ambitious electric vehicle strategy that Porsche had once presented as the future was being scaled back. But there was one surprising exception. One Porsche model was actually growing. And it was the exact car the company had spent years treating as a symbol of the past. The 911. The gasoline-powered sports car that has been part of Porsche's identity for decades was suddenly becoming one of the company's strongest performers. In the United States, 911 sales were reportedly up around 56%, partly as customers who had wanted the discontinued 718 Cayenne and Boxster moved toward the 911 instead. Globally, 911 deliveries also increased significantly, while many other models in Porsche's lineup declined, some by a third or more. Think about the irony. The car Porsche once treated as the exception to its electric future is now one of the few models actually growing. Almost every other Porsche story is about declining demand. The 911 is the exception. And that matters for a very important reason. The 911 is a high-margin vehicle. Porsche makes substantial profit from everyone it sells. So the model that was once treated as the traditional holdout is now doing two jobs at the same time. It is helping support Porsche's sales volume, and it is helping protect the company's profits. Meanwhile, some of the electric vehicles Porsche invested billions in are struggling to attract customers. If the 911 were performing as badly as the Taycan, Porsche's situation would be far more serious. This wouldn't simply be a story about a difficult transition. It could become a story about survival. Porsche spent years preparing for an electric future. But the vehicle helping protect the company today is the loud, gasoline-powered sports car that Porsche once expected to become a relic of the past. In a strange twist, Porsche's past is now helping finance its future. But to be fair, there is another side to this story. Porsche's electric strategy wasn't completely irrational. The company was responding to a genuine global shift toward EVs, changing regulations, and growing demand for electric vehicles. There is also a strong argument that Porsche still has time to correct course. And that is where the story becomes much more complicated than simply saying Porsche made a terrible decision. The real question is whether Porsche can use the strength of the 911 and its traditional models to survive this difficult transition and eventually build an electric strategy that customers actually want. First, let's be clear about one thing. Porsche is not going bankrupt. The internet often skips that important detail. Porsche is still selling expensive cars with healthy margins, especially models customers actually want, such as the Cayenne and the 911. The company also has new leadership and a turnaround strategy that is expected to be presented at its capital markets day later this year. And in hindsight, the direction seems fairly obvious. Build fewer cars. Make them more desirable. Charge premium prices. Protect the Porsche badge. And stop pretending that the entire lineup has to become electric according to a deadline that customers never agreed to. The person now leading Porsche has experience with exactly this kind of challenge. He was involved in developing the Cayenne and Macan programs that helped transform Porsche's business in the early 2000s. So, if any automaker has the brand strength and engineering ability to recover from a mistake of this size, Porsche is certainly one of them. But there is a major problem with that optimistic view. The 911, which is currently helping keep Porsche's finances healthy, can only carry the company so far. There are only so many customers moving up from discontinued models like the 718. Eventually, that extra demand will disappear. At the same time, the electric vehicles that were supposed to become Porsche's future are struggling to generate the kind of profits the company needs. And Porsche has very little control over two of its biggest problems: the decline in China and changing trade policies and tariffs. That leaves Porsche facing a difficult choice. If it focuses heavily on gasoline and hybrid cars because they generate stronger profits, it risks falling further behind in EV technology as the global industry continues to move toward electrification. But if it aggressively pushes into electric vehicles again, it could continue losing money in a market where companies like Xiaomi are already producing highly competitive technology. There is no easy option, and that is why the Porsche story is bigger than Porsche itself. It shows what can happen when one of the world's most respected, best funded, and most profitable automotive brands makes an enormous bet on a future that customers aren't ready to embrace on the company's preferred timeline. Porsche was supposed to be the proof. The proof that a traditional luxury automaker with enough money, engineering talent, and brand heritage could successfully lead the transition to electric vehicles. Mercedes watched. BMW watched. Audi watched. The thinking was simple. If anyone could make the transition work, Porsche could. Instead, Porsche has become a warning for the rest of the industry. Executives at other automakers are now looking at Porsche's numbers and asking an uncomfortable question. If this happened to Porsche, with all of its advantages, what makes us think we are protected? The irony becomes even stronger when you look at what is keeping Porsche alive. The company spent years preparing to move away from gasoline-powered cars. Yet the vehicle helping protect its business today is the 911, the very car that was supposed to represent the old world. Porsche bet heavily on the electric future. The market didn't reject electric cars completely, but it rejected Porsche's assumptions about how quickly customers would adopt them, what they would pay, and what they would value. And the surprising part is that Porsche didn't necessarily fail because it built bad cars. The lesson is that betting your entire company on exactly when that transition will happen, and exactly what customers will want when it does, is incredibly risky. Even the strongest automotive brand can get that timing wrong. Porsche will probably survive. It still has the 911. It still has the Cayenne. It still has enormous brand power, engineering expertise, and decades of experience reinventing itself. But Porsche may emerge from this crisis as a smaller and more cautious company. And perhaps the biggest lesson is this: the brand that once seemed untouchable has just proven that no automaker is truly untouchable. For every other luxury car company watching what is happening at Porsche, that should be a very uncomfortable thought. So what do you think? Can Porsche rebuild its business around the 911 while taking a slower and smarter approach to electric vehicles? Or is Porsche's current struggle the beginning of a much larger reckoning for traditional luxury brands that bet heavily on electrification? Let me know what you think in the comments. And if you enjoyed this breakdown, don't forget to like the video, subscribe, and turn on notifications. Porsche's next chapter is just beginning, and its turnaround strategy could tell us a lot about where the entire luxury car industry is heading.